Alright, so what can you do with $100? Today I'll introduce you to 4 great options. Each one has its own pros and cons, so we'll explore them together and help you find out what works best for you. Let's start with fractional shares. If you've ever dreamed of owning a piece of a big company like Google or Amazon, but thought, wow, these stocks are way too expensive, fractional shares are here to help you. Fractional shares let you buy a portion of a stock instead of having to purchase the entire share. For instance, if an Amazon stock costs $200 per share, you can buy 25% of that share for just $50. This is especially beneficial for beginners, because it means you don't need a lot of money to start investing. This approach allows you to own small pieces of various companies, helping you diversify your investments. Diversification is crucial because it helps you spread out your risk. By investing in multiple companies rather than putting all your money into one investment, you can balance your portfolio and reduce potential losses. However, there are some downsides to consider. Some platforms charge fees for buying fractional shares, and not all stocks are available for fractional purchase. Next up, we have robo-advisors. If you're thinking, wow, this sounds like a robot from the future, you're not too far off. Robo-advisors are online platforms that help manage your investments automatically, based on your goals and risk tolerance. Here's how it works. You sign up, answer some questions about your financial goals and risk level, and then the robo-advisor creates a custom mix of investments for you. It does all the heavy lifting, like buying, selling, and rebalancing. Plus, you can get started with as little as $100. Robo-advisors are fantastic for beginners because they make it easier to start, and they are usually cheaper than hiring a traditional financial investor. But keep in mind, you won't get personal advice from a human, and some platforms may charge extra fees for premium services. When you first sign up, you'll answer a few questions like how much risk are you comfortable with and what are your financial goals. Then the robo-advisor takes over, automatically picking and managing investments for you. Companies like Betterment and Wealthfront are popular robo-advisors that charge low fees and offer automatic portfolio management, making it easy for beginners to get started without needing to know the ins and outs of the stock market. Now let's talk about index funds. When you buy an index fund, you're investing in many companies all at once, like Apple, Amazon, Google, and hundreds more, all in one fund. This is great because you get broad exposure to the market without having to pick individual stocks, and index funds are known for their low fees. Index funds are fantastic for beginners who want to invest long term. You are essentially riding the market, and historically, the market has gone up over the long run. But keep in mind, you won't have control over individual stocks, and your returns depend on the overall market performance. Index funds are designed to mimic the performance of a specific market index, like the S&P 500, which include 500 of the largest companies in the US. This makes index funds a low-cost, low-maintenance way to invest across a broad spectrum of companies. For example, instead of buying individual stocks from each company, you can buy a single S&P 500 index fund and own a small piece of all 500 companies. Then we have ETFs, or exchange-traded funds. These are similar to index funds, but trade like stocks on an exchange, so you can buy and sell them throughout the day, just like individual stocks. ETFs offer a flexible way to invest in a variety of assets, like stocks, bonds, or even commodities, all in one place. They often have lower fees compared to mutual funds, and are great for people who want to diversify their investment without needing to buy tons of individual stocks. ETFs provide an easy way to diversify your investments by owning a mix of assets in one fund. For example, you could invest in an ETF that includes stocks from various industries or bonds from different issuers. Now that we know about some investment options, let's talk about something magical in the world of investing: compound interest. Albert Einstein himself called it the eighth wonder of the world. So what exactly is compound interest? Think of it like this. Compound interest means that the interest you earn also start earning interest. Let's say you invest $100 at a 5% rate. At the end of the first year, you'll have $105. But in the second year, that 5% gain in interest applies to the $105, not just the original $100. So now you're earning a bit more interest, $5.25. Instead of $5. Over time, this compounding effect helps your money grow faster and faster. And the best part, you don't need a lot of money to see big growth. The key is starting early, being consistent and adding money when you can. Even small, regular investments over time can grow into something big. Compound interest works because it earns interest on both your initial investments and the interest that's been already earned. For example, if you invest $100 at 5% interest per year, you'll have $105 after 1 year. In the second year, you're earning interest on the $105, not just the original investment of $100. So you'll have about $110.25 after the second year. This process repeats and your investment snowballs. Adding regular deposits boosts growth even further, as each new deposit starts earning interest as well. Now, before you jump into investing, it's a great idea to set some goals. Why are you investing? What do you want to achieve? Are you saving for a big purchase, like a car or a house? Or maybe you want to build a retirement fund that can grow over the years. Setting goals helps you stay focused and gives your investing journey a clear direction. And remember, your goals can start small. You don't need to aim for $1 million right out of the gate. Instead, think about something achievable, like saving $500 or $1,000 over time. As you see progress, you can build bigger goals. Goal setting in investing helps you stay motivated and understand what you're working towards. For instance, if you're saving for a $10,000 down payment on a house, you could break that down into smaller goals, like reaching $1,000 first and then $5,000. Each milestone builds your confidence, and before you know it, you're much closer to your main goal. It's a bit like training for a marathon by starting with shorter runs. Alright, now that you have a few options and goals in mind, let's go over some practical tips to help you start strong as a new investor. First thing first, start small and build up gradually. Don't be afraid to start with just $100. The beauty of investing is that you can start small, see how it works, and then invest as you gain more confidence. You can even set up automatic transfers each month so that a small amount goes into your investment account regularly. This helps you build the habit without having to think about it. Next, educate yourself. Investing can seem complicated, but it doesn't have to be. Knowledge is your best tool. Books like The Intelligent Investor or Rich Dad Poor Dad are great resources, and of course I've got more videos on this channel to keep you learning. Learning the basics of investing empowers you to make smart decisions. The more you know, the less intimidating it becomes. Aim to understand core concepts like stocks, bonds, and compound interest. Online courses, podcasts, and YouTube videos can help you build a strong foundation. Diversify, diversify, diversify. In investing, there is a saying, don't put all your eggs in one basket. This means spreading your money across different types of investments, so that if one performs poorly, the others can help balance things out. Let's say you invest in stocks, bonds, and a little bit of index funds. If one has a rough day or year, the other investments can help protect your money. Diversification is a strategy to help protect your investment portfolio from big swings. By holding various asset types like stock, bonds, and funds, you're not only relying on just one investment to perform well. Diversification smooths out the ups and downs, creating a more stable portfolio. Be patient and think long term. Remember to be patient. Investing isn't about getting rich overnight. It's about slow and steady growth. The stock market will go up and down, but historically, it has trended upwards over the long term. If you are in it for the long haul, don't panic when you see a temporary drop. Stick with your plan and remember that investing is a marathon, not a sprint. Being patient and resisting the urge to sell during dips is key to successful investing. One of the best things you can do is set up automatic contributions. Even if it's just $10 a month, every bit counts. This helps you invest regularly without having to think about it, and that consistency adds up over time. Monitor and adjust as needed. Lastly, it's important to keep track of your investment over time. But don't stress out if the market drops down for a day or two. It's totally normal for the market to go up and down. That's just how it works. Instead of worrying over every little change, try to check in every few months and see how your investments are performing. If the market goes down one day, don't panic. It happens to everyone, and these short-term drops don't usually reflect the long-term trend. The key is staying patient and focused on your long-term goals. If you found this video helpful, hit that subscribe button. And if you're looking for more ways to grow your income, check out my other video, 12 side hustles you can start today. Trust me, you don't want to miss it. Thanks for watching and I'll see you in the next one.